Time for hot picks. And we're going to veer away from tech for a little bit. Our guest says investors may want to take a look at some US dividend payers that are not hitting records, so they're currently out of favor. Let's get more from Greiner, Senior Portfolio Manager at FM Investments. Thanks very much indeed for joining us, Christian.
Thanks for having me this morning.
And just remind us, the numbers do show historically dividend stocks can be the place to be.
They can be, especially at these times in the market. We're kind of at an interesting juncture in the U.S. markets. On the short term, as we've seen over the last 5 or 6 trading sessions, we saw that price momentum trade really start to sell off. Investors are getting out of some more crowded names that drove the U.S. markets to the new records. Part of that might be renewed inflation fears, and part of that might be people re-examining the AI trade and the profitability there. When we take a look at it from a little bit farther out, for the S&P 500, the forward PE is at about 22 times right now. Historically, that's meant more muted returns on a medium-term basis. So you'd see low single-digit returns for a 1 or 5 year basis. So when you have a return environment like this, dividends matter all the more. So what we do is that we take a look at dividend-paying companies that really aren't near, their all-time highs here. Might be a little bit out of favor with investors. But what we're looking for are ones that have taken tangible, observable steps to improve their returns.
FedEx is your first idea. Yield of about 2.5% and the stock down about 17% this year.
Yeah, so this is one of those where you have to take a look at what management is doing to adjust to a very volatile environment. And so they're a transportation industry bellwether, and they've been left behind despite the global economy is sort of shaking off some of these issues with the tariffs here. And they were one of the companies that didn't give full year 26 guidance, given all the uncertainty. That led to some volatility in shares. But when we take a look a little bit at what's been going on in the earnings, the express business beat on higher than expected volumes. The freight business saw shipment declines just to about minus 1%. Those were at minus 5% drops year over year over the past few quarters. So we see some improvement there. But more importantly, we're seeing them see gains in international priority shipments. Domestic package volumes it's showing that they are gaining share in the market. And this is a very nimble management team. They lost the USPS air cargo contract in late 2024 and adjusted pretty well. And they adjusted their net capacity pretty well in May in the teeth of this tariff uncertainty.
Your next idea is Comcast, a yield of about 4%, and of course a sprawling company in media and communications, streaming, cable. They just pulled off a spin-off. What's the attraction here with Comcast?
Well, what is the attraction here is that number of businesses and that we're seeing progress on all of those businesses finally. For a while with Comcast, it was, they were hitting on all cylinders in media, and maybe broadband wasn't doing as well. Now we're seeing management really take steps across the board here. And for them, at just the 8 times forward PE, you're going to be paid to wait to be a little bit patient here, especially with that 4% dividend yield. But when we take a look at these underlying businesses, what stands out, of course, is the media and entertainment business, and that includes the theme parks. The theme park business growth is reaccelerating. They opened Epic Universe down in Orlando. Good attendance in May. They have a kids park coming in Texas next year, and London farther out on the horizon. In terms of the media, as you touched on, you have the Versant spinoff of the cable networks here. That's going to unlock shareholder value. It's going to allow those to be really valued at an appropriate multiple, get rid of that conglomerate discount. And in terms of the rest of their media empire with NBC Universal, they're going to be focusing more on sports here. You're going to see Peacock raising prices, but their offerings in the NBA, having the Olympics and the Super Bowl in 2026, that's really going to start to come through here. As in terms of the broadband business, they've simplified what they've been doing. They've finally been listening to their customers, and the value proposition there in terms of a simplified prices, lowering some prices, and a 5-year lock-in are going to really help.
And finally, Target. Investors apparently displeased to hear that they're not bringing in an outsider to head the company. Yield of about 4.5%.
Yes. So this week they appointed Michael Fidelki as the successor, and a lot of people were looking for an outside hire. And given the company's issues, you can see why. CEO Brian Cornell is still going to be executive chairman here. So it's going to be hard for Fidelity to say, this is how we're supposed to turn around the company when the old CEO is still there in the boardroom here. But this promotion for Fidelity, this is an individual that, a few months back, they said this is the person that's going to be sort of turbocharging our investments in fulfillment and technology and get the company back on track. He knows what the issues are, and he is starting to really put out his vision for this. They're going to have to invest in price, they're going to have to invest in technology and fulfillment, and that's going to hurt margins in the near term. But with all these big retail leadership transitions in the past, we've seen these margin resets. Target's going to have to get that middle class to upper income consumer back in the stores. And it's going to be through offering, making sure that the shelves are properly stocked, and redoing that online fulfillment model.
Christian, we heard that Target Associated Press and other sources indicating that Target has neglected some of its stores. They're seen as cluttered by some customers. That would seem, I think you could turn around, but it would point to management lapses.
It would point to management focus maybe going off a little bit of what had made Target such a darling in the retail space here for years. But for them, what you're going to see that is, even with the loss of the Ulta partnership in August 2026, this is still a company that's going to be earning $7 or $8 per share here. And overall shareholders are going to be paid between the dividend and an aggressive share buyback program to kind of wait this out and see what Fidelity can do to turn this around and bring these shoppers back into the stores.
Christian, thank you very much indeed.
Thank you.
Christian Greiner, as Senior Portfolio Manager at FM Investments.